Okay, welcome. Is it working? Yeah. Welcome, everybody. I'm Andrea Montanino. I'm the director of the Global Business of Economics program here at the Atlantic Council. A special welcome to European Commission Vice President Dombrovskis, his team, and to our partners from SIFMA, who are co-hosting today's event. Before I start, for all of you who follow along on Twitter, please use the hashtag EU growth, which is the hashtag of the Euro Growth Initiative. In fact, this event today is part of our larger initiative on Europe, which is aiming at identifying transatlantic solutions for long-term growth in Europe. This initiative is chaired by Ambassador Stuart Eisenstadt and the former President of the European Commission, Jose Manuel Barroso. We launched the initiative in March 2016. We hosted already 4 European commissioners. We hosted Vice President Dombrovskis last April, and we are honored that you are joining us today again. You seem to like the Atlantic Council, and we are very happy for that. On a day when we discuss the future of financial and capital markets, I'm delighted to be working together with our partners from SIFMA, who are advocates for effective and efficient capital markets, which is something really Europe needs. Before handing over to Mr. Ken Benson, President and CEO of SIFMA, I want you to add on your calendar another Eurogrowth initiative event this Thursday. So we will host a 1-hour panel we called Go for Growth Europe, with the exclamation point with Gordon Bajnai, the former Prime Minister of Hungary and the COO of Meridian, with Stu Eisenstadt, a long-standing career in government service as Deputy Secretary of the Treasury, among other things. Professor Jay Shambo is member of the Council of Economic Advisors at the White House, and Paul Scher, the Chief Economist of Standard & Poor's. So it is this Thursday at noon. Please write on your calendar. So I want to see everybody here next Thursday too. But Ken, the floor is yours.
Thank you, Andrea, and again, good afternoon, and thank you all for being here. I really do want to thank the Atlantic Council for co-hosting this event and literally hosting the event with SIFMA. It's very important to us. It is a privilege and honor to host our distinguished guest, the Vice President, European Commission, Mr. Valdis Dombrovskis, who as of today, or I guess maybe Saturday, we were discussing, is taking responsibility for the Commission's financial stability, financial services, and capital markets union portfolio from Lord Hill. In fact, I was in Brussels the Tuesday prior to the United Kingdom vote and had the opportunity to meet with Lord Hill and members of his cabinet. And with so much on the EU's agenda, it is more than encouraging. In fact, I think it is really a powerful statement that Vice President Dombrovskis so quickly has taken the time to visit the United States. Today's conversation comes at a critical time as the recent vote in the United Kingdom to leave the European Union has changed the political landscape in Europe. And we in the United States are on the precipice of change in our government with the pending November presidential election. Despite these respective events, one thing remains constant is the long-standing partnership that has existed between the United States and the European Union. It is this relationship that has fostered cooperation and collaboration on many fronts and across a myriad of industries, including financial services. Today is an opportunity for us to discuss some of our key U.S. and EU priorities and lay further groundwork on our collective efforts to boost growth on both sides of the Atlantic as well as globally. We will begin with remarks from Vice President Dombrovskis for about 15 minutes, after which John Rogers and the Vice President will have a discussion further exploring some of the key themes and issues. There will be an opportunity for a few questions from the audience at the end. With that, it is now my great honor and privilege to introduce our distinguished speakers, Vice President Dombrovskis and John Rogers. The Honorable Valdis Dombrovskis is the European Commission's Vice President for Euro and Social Dialogue. As I mentioned, he's taken over the portfolio for financial stability, financial services, and capital markets union, in addition to his current responsibilities. Mr. Dombrovskis served as the Prime Minister of Latvia. Before that, was a Minister of Finance and Chief Economist at the Bank of Latvia. In addition to that, he's also been a member of both the European and Latvian parliaments. John Rogers serves as Goldman Sachs Executive Vice President, Chief of Staff, and Secretary to the Board of Directors. He's also currently Chairman of SIFMA's board and has served as a board member for the last 4 years. In addition to serving as SIPMA's current board chair, prior to joining Goldman Sachs in its fixed income department in 1994, John spent his career in government service as an Undersecretary of the Department of State, an Assistant Secretary of the U.S. Treasury, and as an Assistant to the President at the White House. He's a recipient of the Presidential Citizens Medal. With that, it's my great pleasure to turn over the dais to Vice President Dombrovskis.
Ladies and gentlemen, it's good to be back in Atlantic Council. As it was already mentioned, I was here 3 months ago speaking about how Europe is adapting to global developments. I set out the work we are taking forward to be able to deal with the unexpected. And since then, the unexpected has happened. For the first time, a member state has voted to leave the European Union. That's a challenge which goes to the heart of the European project. Getting the response right will be crucial for Europe's future. Following the resignation of my British colleague, Lord Hill, I have been asked to take over his responsibilities, once again, as it has been mentioned, for financial stability, financial services, and for building a single market for capital in Europe. And I'm pleased to be here in Washington, D.C. in the first working day in this new job. So what my approach will be? Above all, continuity. Lord Hill has done excellent work over the past 2 years to deepen the capital markets, to strengthen Europe's banking union, and to review existing regulation to check and make sure that it's as growth-friendly as possible. He has built momentum and support across the piece. So this is a work to be built on. And where we can, we will quicken the pace of this work. Following the UK's decision to leave the EU, ensuring financial stability is our first priority. We need to work towards the outcomes that gives European industry and our international partners as much clarity as possible. It is in our collective interest to maintain an environment friendly to investment and growth. And we want the UK to remain a close partner. But any future agreement concluded with the UK as a third country will have to balance the rights and obligations. Access to the single market would require the UK to accept 4 freedoms: free movement of goods, services, capital, and labour. And the first step now needs to come from the UK. The new government has to set out what it wants in its future relationship with Europe. That will give us more predictability and the basis on which to negotiate. And it's worth to emphasize that until UK leaves, and there is at least 2 years negotiating period, it remains a full member of the European Union with all the rights and obligations this entails. Our immediate focus is to deal with uncertainty arising from the UK vote. The EU economy has what it takes to cope with downward pressures on growth the referendum has created. Our preliminary assessment shows that uncertainty stemming from the vote to leave the EU could reduce the UK's GDP by 1 to 2.5 percentage points by 2017. In the other 27 member states, the impact could be between 0.2 and 0.5 percentage points. So the pressure is real. But if we respond with the right policies, we are able to limit the impact of this adjustment. That should be the main goal for both sides in the upcoming negotiations. Politically, the remaining 27 member states have shown a strong commitment to stay united. That is a feeling that extends well beyond political leaders. In Germany, opinion polls last week showed a 13% increase of support for European integration. There are similar sentiments in other countries. And none of Europe's core strengths has disappeared. Europe's talent for innovation is still there. Our industry is still competitive. Our workforce is still highly productive. Now moving to the questions in the banking sector. The EU's banking sector now is much more resilient than it was during the crisis. Our regulatory architecture has been strengthened, and the supervision and resolution of banks are now coordinated at the European level. Our banks are better capitalized, and asset quality has also improved. The ratio of non-performing loans has been decreasing in recent years, and the coverage ratio is increasing. Despite historically low interest rates, bank deposits have been rising. This makes banks' refinancing more stable. Favorable financing conditions, partly due to the ECB's accommodative monetary policy and stronger demand for loans, is supporting the recovery in bank credit. Meanwhile, the costs of borrowing for companies and households have further converged across the euro area. Completing Europe's economic and monetary union, which covers Eurozone, is an essential part of maintaining stability. So the work on banking union continues. This means properly implementing and enforcing EU's new regulatory framework to protect depositors and taxpayers. Nearly all countries across the EU have now implemented rules governing bank recovery and resolution and deposit guarantee schemes. European finance ministers have committed themselves to setting up a common backstop to the Single Resolution Fund. Technical work to make it happen will start soon. We have also come forward with a proposal for a European deposit insurance scheme. This is a missing third pillar in the banking union. It is part of a much broader plan to deepen our economic and monetary union. The objective of European Deposit Insurance Scheme is to gradually mutualize all national deposit guarantee schemes across the EU. This sharing of risks will be accompanied by further risk reduction measures. This is a balanced approach we need to make progress. We are also driving forward work to build a capital markets union. Some have asked whether we should continue with this project now that Europe's largest financial market is about to leave the EU. And we believe that UK's referendum vote means that we need the Capital Markets Union more than ever. The goal of the Capital Markets Union is to help capital flow throughout the EU. At its heart, it's an effort to improve the funding opportunities for businesses. For companies in their startup phases, we have just amended existing legislation governing venture capital funds to build up scale, diversity, and choice. To free up bank lending to the wider economy, we have made a proposal to restart Europe's securitization markets. For companies that are growing, we are overhauling legislation to make it simpler, faster, and cheaper for companies to raise money on public markets, the prospectus regime. We also want to look at the existing private placement markets that work well and see how we can build on them to help medium-sized companies raise capital. To create deeper capital markets for companies of all sizes, we want to knock down some long-standing barriers to cross-border investment. This year, we will bring forward proposals to try to reduce differences between national insolvency regimes to give cross-border investors more certainty. We will see whether we can simplify the system to reclaim withholding tax when these are subject to double taxation. And to inject more savings into capital markets, we are considering proposals for a European market for simple personal pensions. As part of the CMU action plan, we would work at the financial service legislation that we have passed to make sure it's working as intended. We have just completed our analysis, and we are now taking forward recommendations to increase funding to the wider economy, make our legislation more proportionate, and to reduce the compliance burden for businesses. Moving to the EU-US relations. The United States and EU already have a strong trade and investment relationship. Together, our markets make up 50% of the global GDP. We are each other's first source and destination for foreign direct investment. Flows of capital across the Atlantic continue to grow. I believe this relationship can be driven further in both directions. My meetings in Washington this week will concern regulatory cooperation. This morning, I discussed with my counterparts our joint approach to implementing international standards. The EU is working to implement total loss absorbing capacity in time. We want to find an intelligent way to making it fit with our own system, the minimum requirements for own funds and eligible liabilities, or MREL. I was also interested to hear more about the implementation of Tilak in the US. It's important we maintain a level playing field for companies in both jurisdictions. We have made good progress in preparing the EU system for CCP recovery and resolution. We will publish a legislative proposal in this area later this year. And we are also preparing a legislative proposal that will help to finalize EU implementation of the Basel III package. I'm delighted that we have been able to set up a new platform for regulatory exchange between the EU and US financial regulators and supervisors, a joint EU-US Financial Regulatory Forum. The US and EU financial services industries attach great importance to regulatory cooperation. We need to build on successes we have had in recent months with our agreement on cross-border derivatives regulation, allowing US CCPs to provide services into Europe and EU CCPs into the US. We are clear that we need to talk to each other more often, to clarify the scope of future rules, to ensure we understand the impact of legislation on the ground, even beyond our own jurisdictions, and to promote the recognition of each other's standards. This should reduce compliance costs and improve implementation. We should continue working towards further regulatory cooperation as part of TTIP. The forum we launched today will meet more often than its predecessor, the Financial Markets Regulatory Dialogue. Its purpose is to identify potential problems at the earlier stage of regulatory process. The US Secretary for the Treasury and I will meet once a year to review the functioning of the forum and agree priorities for future work. This provides a solid basis for improved cooperation. To conclude, as you'll see, we have an ambitious agenda. In Europe, we are working to complete the banking union. We will continue to press ahead with our efforts to deepen our capital markets, and we will act on our review of existing legislation to make our regulatory framework as growth-friendly as possible. And I'm pleased that we have been able to deepen EU-US cooperation. This gives us a firm basis on which to move forward, to maintain stability, and to support growth on both sides of the Atlantic. Thank you.
What you prefer? Right here. Great. Well, ladies and gentlemen, I'm very happy to be here and to be with the former Prime Minister. It was referenced in my bio by Ken Benson that I had worked previously at the State Department. And I note that during that time, which was 25 years ago, but that was at the time of the ending of the Cold War and the dissolution of the Soviet Union. And most of my responsibilities were set on the recognition of which was principally 15 republics of the former Soviet Union who became independent states. And so I spent time in your capital, your home country, and it's quite wonderful to see that over the course of those years, the progress that has been made is quite heartening to see. I also note that at the time when the Vice President became Prime Minister of Latvia, it was through a period of economic challenge as well. And I remember reading at the time that there was a discussion of, well, he was chosen to do it because nobody else wanted to take the responsibility for guiding his country forward. And I likened that to his new responsibilities, and I wonder whether or not that you received this additional portfolio on the same basis that given all the challenges it faced, whether anyone else wished to take on these challenges. But we're very happy to have you here. And maybe I could begin our discussion with the point about uncertainty. You know, markets don't like uncertainty. It actually distorts investment, it puts people on the sidelines, and they're constantly moving to try to find the degree of certainty that they can find in anything. And outside of what you've already said in your other remarks, and as well as when you were in front of the European Parliament more recently, that Britain remains a member until at such time as they exercise Article 50 and take that action. But what assurances can you give to the markets about the future and to the future in which Britain is a participant, maybe not in the same degree, but I think for any financial institution, this is probably, that sector, probably more disruptive than just about anything that has occurred, certainly since the financial crisis. So I wondered if you could comment a little further about that.
Mm-hmm. Well, so as regards, so to say, aftermath of UK referendum, as I said, the first steps need to be taken by the UK government, which needs to set up the plan how to build its future relations. And not that it was a big surprise, but of course we saw it confirmed after the British referendum that those people which were campaigning for Brexit actually didn't have a plan. So Brexit was voted and there was no plan. So one can understand the difficulty now of the new government, that they actually now need to set up this plan. So what happens after the Brexit vote? And this is what is happening right now, and we realize that it may take some time for British government to prepare its relations with the EU. And there, the strategic choice which UK government needs to make is whether it wants UK to remain part of EU internal market or move outside it. And there is a possibility for countries to move outside the EU and still be part of EU internal market. European Economic Area, we can mention Norway as an example. So this possibility exists. But this possibility comes with certain conditions. First, as I mentioned also in a speech, it means respect to the four freedoms: free movement of goods, services, capital, and labor. It means financial contribution to the EU. It means respect to the EU rules and regulations. If UK is willing to accept those conditions, it can continue to be part of EU internal market. We know, of course, that this is politically complicated because exactly some of those conditions were the ones Brexiteers were campaigning against. But this is a choice we cannot now make for the British government. So they need to make the strategic choice, and then we are able to negotiate and find best possible solutions. For the financial markets, for financial services, as regards, for example, the issue of passporting, of course, remaining part of EU internal market is by far less disruptive scenario. But at this stage, I'm not in a position to tell what strategy UK government will make. And that's why from EU institutions, from European Commission, for other EU institutions, we are calling on the British government to come up with this proposal, also the notification of starting those negotiations for leaving without unnecessary delay, to provide clarity and to provide some direction for further work as soon as they can.
You know, to this point, at the Eurofin Council meeting, I believe last week, and the press conference that followed it, which you participated in, one of the things that was discussed at that time, and you mentioned your own remarks, and certainly is reflected in the communique, is that the standards that currently are being revised at the Basel Committee, that the European Commission needed to speak and the European states needed to speak in one voice at Basel. And in addition to that, that there had to really be striking the right balance between being prudentially sound and allowing the banks to finance the real economy. And as you've noted in your other remarks, that the banks in the European zone, 25 million euros worth of loans to businesses. Insurance represents 1/3 of the underwriting that happens in the country, and a very important, vital financial sector. Can you just elaborate on what you meant at that conference, and perhaps even the issue of proportionality? Because Basel III commitments to be introduced across 8,000 banks in the Euro sector, and yet there's been a lot of discussion about that application as being proportionate, particularly to smaller institutions and the effect that these enhanced capital standards could have on them. Could you discuss that?
First it's worth underlining that also at G20 levels there was agreement that finalization of Basel III should not lead to significant additional capital requirements for the banking sector. And this was more or less what was reiterated in the last EU finance ministers meeting in ECOFIN Council. They basically reiterated this point and emphasized the need for coordinated European position when discussing the completion of the Basel III. Indeed, one of the points which is being raised is this balance between stronger prudential standards and the needs to finance the real economy. So this is something which we will need to find this right balance. But in any case, from EU side, I can say that we are committed to work to finalize this work on Basel III and find the right way forward as regards all those requirements. The question of EU coordination is, I would say, wider. It clearly goes beyond Basel. There are a number of areas where we think that as a European Union we can achieve more if we work in a coordinated way. Would it be our work in IMF or Basel or other international fora? And this is a part of the general work which European Commission is now doing, trying to ensure coordinated European positions in international fora, especially as regards financial sector.
In fact, the work that Lord Hill undertook in terms of the call for evidence, in the discussion that you had with the European Parliament, you had discussed that certain themes were beginning to emerge from that. The legislation, some legislation was not fully proportionate in some areas, as we just touched upon. That legislation could be weighing on the amount of financing that would be available, and that there was a discussion that came through, at least in some of the analysis, of the compliance burden. So just turning to the goals that are stated, particularly in the annual growth survey work about investment, how do you tie in this work of Lord Hill's, and if those themes are in fact emerging, to what course, the future course that the European Union may take?
Indeed, when I was taking over this work and had discussions in European Parliament Econ Committee, I was outlining that one of the main goals we want to achieve is to ensure that financial sector is financing the real economy. I would say those are a little bit two slightly different topics. If we regard how we promote investment, I can come back to this, and call for evidence. So on call for evidence, indeed, what we have done in the EU, we had asked the EU financial sector, other stakeholders to come up with evidence, come up with concrete examples how the newly set regulation is working, and whether there are some unexpected problems arising, some overlapping, some gaps in a regulatory framework, and to assess whether we can reach the same macroprudential results with, or prudential results generally, with more growth-friendly way. And indeed, overall, the response was, I would say, positive. Nobody was questioning the overall framework which has been created, and it's worth noting that in any case, the purpose of this call for evidence is not to weaken the regulation, not to weaken the prudential standards, but really to see whether we can reach the same prudential standards in a more growth-friendly way. And indeed, there were several topics which were emerging, including of proportionality of some regulations, including administrative burdens, some overlapping or not entirely overlapping, but similar reporting requirements, a number of other questions. So what we are doing now, we are doing the assessment of this input which has been provided to the European Commission, and then we'll be coming with proposals how to approach it and how to address the problems which had been raised during this call for evidence. Then on promoting investment you raised, I would say this is a much broader question. If we look at EU's economic policy priorities, our economic policy priorities are currently geared towards strengthening the EU's economic recovery. We are in a fourth year of economic recovery. We expect 1.8% growth in the EU this year. But we clearly need to strengthen this recovery. And therefore, we have set three priorities. One is to facilitate investment, another structural reforms to modernize our economies, to strengthen the competitiveness, and third is still to continue with fiscally responsible policies. And as regards this investment part, this was indeed one of the first initiatives of this European Commission, setting up investment plan for Europe, also known as Juncker Investment Plan, with the aim to mobilize additional 300 billion euros of both public and private investment within 3 years. And by now, projects which had been approved so far unlocks investment well above 100 billion euros. So one can say that we are firmly on track in reaching the goals of the investment plan for Europe. But it's not only about projects which we support, it's only about investment environment. That's why this year, when dealing with EU's and EU member states macroeconomic governance questions, when addressing country-specific recommendations to the member states on what they need to do to address structural problems in their economy, we were putting particular emphasis on barriers for investment. So looking at both at EU level and at individual member states level. And of course, part of this work is linked also with the financial sector. Clearly, the financial sector's ability to finance the real economy. I also was mentioning one of the factors hampering cross-border investment, which is insolvency frameworks. We will also be coming with some proposals what we can do at the EU levels in terms of streamlining insolvency frameworks, and actually there's much more.
Well, in terms of relaunching investment, and I believe you're speaking in terms of the European Fund for Strategic Investments, and one of the reasons given for that fund was the degree of uncertainty that exists, the lack of really risk financing, and broadly regulatory burdens within. Does this connect with the strategic, or I should say the relaunching of this investment, connect with the work that Lord Hill has been pursuing on behalf of the Commission in terms of this call of evidence? And will this be weighed in terms of actually how to go beyond this fund?
Once again, I would emphasize that those are probably two issues we need to distinguish somewhat. Investment plan for Europe is, I would say, much wider issue on how to stimulate investment in Europe, setting up a dedicated fund, looking at investment obstacles, administrative barriers in different member states. A call for evidence is really to assess what is the outcome of regulatory framework which had been created as a response to the global financial and economical crisis. But as such, we know that it was created, so to say, on ad hoc basis as a response to the certain problems. And now we are trying to make some kind of a overview of what has been done and what needs to be done to make this framework overall more consistent and eliminating some overlaps, some in unintended consequences, some gaps. Of course, in a sense, you can say that by achieving the same prudential results for a financial sector in a more growth-friendly way, we'll be able to unlock more financing of the financial sector to the real economy. So everything is linked somehow one way or another, but I would not tie those two questions too closely, because they are two different strands of work.
Yeah, and I think that's absolutely true, that things are quite interrelated. And as you mentioned, the ad hoc nature of things, certainly the United States pursued its financial reform in a single, very broad piece of legislation, Dodd-Frank. I think I remember counting in the European Union 41 separate dossiers to consider it, and on a much slower basis, and therefore a different perspective, or what you've described in other remarks as being within the European context to consider the application. So let's turn to your announcement this morning, your exchange of letters with Secretary Liu regarding that framework. Can you tell us a little bit more? Is there more substance to this forum than the name change? Because up till now, I would say that a large number of people view the U.S. regulatory response as being somewhat uncompromising. So do you think that you will be able to, through this new vehicle, actually be able to bring that European perspective, maybe some of the themes from the call of evidence, in the discussion of the international framework?
In general, my intention is to continue with also my predecessor's Lord Hill approach on evidence-based decision making. And in this context, of course, it's very important that the world's biggest economies actually talk to each other and understand better each other's regulatory frameworks, and to the extent possible take into account concerns raised by our counterparts. So that is reason why this cooperation was set out in the first place, and why we now upgraded it to the joint EU-US Financial Regulatory Forum, which also intends to meet more often, and we hope will be able to really understand better each other concerns, allow better links between regulators and supervisors in EU and US, because as in US, also in EU, there are different entities which are involved in this work. And also, if we work closer, we come closer to the common approach. It's also, I think, easier to convince the rest of the world, so to say, of certain approaches. If we come with different approaches, then it's more complicated. So I see this more as a forum for coordinating our positions, understanding better each other concerns, and to the extent possible taking into account the concerns raised by other counterparts.
So an example of that would be TLAC, the total loss absorbing capacity that you mentioned in your remarks, because certainly you've mentioned before in other remarks that it has to fit the EU standards. So is that an example of where you would be bringing into this forum a discussion of that approach on TLAC, for example?
Well, TLAC is certainly one of the issues we would discuss in this forum, because now both US and EU are working on implementation of TLAC. So it's important that this implementation actually provides level playing fields, that there are no some de facto discriminatory provisions in this application. And in the case of EU, of course, it needs to be taken into account that we have our framework already in place in form of MREL. But MREL is something which applies to all EU banks, and in this case, TLAC only applies to the globally systemically important banks. So there we need also from our side to see how we fit those two approaches together. Both approaches serve the same mean, that if there is a need for a bail-in in case of the bank failure or something, that there is actually possibility for this effective bail-in. But in a case of Europe, for us, it's important really to ensure that it does not end in some kind of a duplications of tasks for the banks, that we are applying the TLAC in a way which is compatible with MREL.
I attended a few years ago the Eurofeed conference in Greece. Then we had the Eurofeed conference in Riga, which you spoke at. But one of the questions that always seems to come up is the securitization market. What do we need to do to jumpstart securitization? How can we progress in securitization? Can you give me a view about how you see the securitization market within Europe and growing?
Well, as you know, we now have a major initiative on simple, transparent, and standardized securitization, so-called STS securitization, which we hope will help to revive the securitization market in Europe. It must be said that post-global financial economic crisis, the idea of securitization has gotten some kind of stigma, not least because of the subprime crisis in US. So we need to learn the lessons from there, not to create some kind of very opaque financial instruments. And that's why there's emphasis on simple and transparent and standardized securitization, one form of to having uniform assets in those securities, having sufficient information for potential investors, what's in those securities, what are the potential risks, and so on and so forth. So this proposal is already put forward by European Commission and is currently discussed by EU co-legislators, EU member states and European Parliament, and we hope that we'll be able to move forward with this proposal on securitizations.
In terms of bank structural reform, this has been going on, discussions for some time. Lord Hill's predecessor began an effort to examine the outcomes of that. It's taken different courses between what the structure should be, the limits on proprietary trading, different things. Recently, there's been talk about whether or not separation between investment banking and retail banking should take place. Can you give us your view about where you see the bank structural reform? Is it basically on the back burner, or do you think that this, once the call for evidence is complete, the European Commission will turn to that?
Well, as you know, European Commission has already put forward a proposal on bank structural reform. It must be said that this proposal is currently stuck in European Parliament.
Yeah.
So my intention is, in any case, to talk with members of European Parliament dealing with this file and see what are the concerns and what are the possibilities to move this proposal forward. There are a number of concerns which we need to understand and which are legitimate concerns, how it would affect, for example, market making provided by the bank, some other concerns, but I believe that the overall idea of the proposal dealing with the banks which are too big to fail, to address this situation, it's something which is worth pursuing. So my intention is to meet our legislators and to see whether there are ways to unblock this proposal.
Let me turn to our audience now and see if there's some questions that we have here. Yes, right over here. There's a microphone right here. If you could identify yourself.
Sure. Fran Burwell here at the Atlantic Council. The ECB launched an effort earlier to try to prevent London from remaining a clearinghouse for euro transactions. And that was decided last year by the ECJ, as I understand it, that there could be no discrimination against member states of the EU. It didn't matter whether they were in the Eurozone or not, just no discrimination between member states. If the UK ends up as either a participant in the single market or even farther afield, do you expect that effort to be relaunched? And would you expect, have I interpreted the ECJ decision correctly? And would you expect it to maintain that it's EU members that can clear Eurozone euro transactions or not? Thank you.
Okay, on this euro clearing question, well, if we look strictly at this European Court of Justice decision, clearly there was this reasoning in a background of non-discrimination within EU. But the kind of immediate reason for rejecting this ECB's proposal was a question of ECB's competence, whether ECB is in competence to take those decisions. So, but nevertheless, I would not say this is a most urgent problem on our first issue we would now be dealing with. But in any case, one cannot exclude that this issue will be put back on table. I cannot comment much on this because also in a previous case, when it was a court case, European Commission was not part of this court case, so therefore probably I will not enter in detailed deliberations right now.
Yes, right here, sir.
Hi, Brett Fordham from Inside U.S. Trade. I had a question about the announcement this morning. I know the EU's position in TTIP has been that financial services regulatory cooperation should be included in that, and up until just last week had been withholding its market access offer for that. I was wondering, I know you mentioned in your speech that that position hasn't changed in the sense that regulatory cooperation needs to be involved. But if so, then why come forward with the market access proposal? And more specific to the forum, other than the regular meetings, what reforms are included that make it different than the FMRD? Is there more opportunity for stakeholder input?
Okay, so on the question of TTIP. Indeed, EU's position has been that when we discuss trade negotiations, we typically argue for a broader scope of those negotiations, not covering only customs tariffs, but also going into other areas like public procurement, like regulatory cooperation, geographic indications, number of other areas. And this has been also our approach in case of TTIP negotiations, that certainly our preference is for a broad and ambitious agreement. There, as regards regulatory cooperation, we had some discussions, as you are aware, and this setting up of this financial regulatory forum was as one way to address those practical concerns, if you want, which had been raised by the EU on how we can strengthen this regulatory cooperation. So certainly we think that this is a step in the right direction, and certainly helps to address a number of issues. That said, from EU point of view, we still have not changed our approach of in trade agreements to make them broad and ambitious trade agreements, not limited only, strictly speaking, to the customs tariffs, but addressing also other non-tariff barriers. So that general approach also towards TTIP has not changed.
Another question? All the way in the back of the room? Gentleman with his hand up. He's bringing you a mic right there.
Hi, Andres Gill with the U.S. Chamber of Commerce. I was hoping you might be able to comment a little bit about the European Commission's decision in early June to delay collection of initial margin. This has been a big issue for not only a lot of people in this room, but also users of derivatives, and depending on excuse me, integrated markets throughout the entire world. There's been a bit of a concern that with the European Commission decision not to move forward in September, there will be a fragmentation in the markets. And I know there's been a lot of discussion of this recently in terms of trying to find a harmonized date. I was hoping you could kind of discuss that, this current status of negotiations and what steps the European Commission might be doing to kind of minimize that fragmentation.
Mm-hmm. Okay. Well, first of all, two things I would like to emphasize in this context. First, that EU is fully committed to implement what has been agreed. So our proposal will fully reflect the agreements reached. And second, that we'll be putting forward our revised proposal already by end of July. So by end of the month, proposal will be on table. Then the issue is that the decision-making process in the EU is somewhat more complicated. It will require agreement of co-legislators of EU member states and of European Parliament. And their European Commission, as an executive branch, if you want, is not fully in control of legislators' agendas. But from the Commission point of view, we will be pushing for really as quick legislation process as it is possible, so to minimize this delay to the extent possible.
We have time for one more question right back here. The lady right on the edge there.
Tara Jeffries, Morning Consult. I'm going to go a little further afield in the hope that you can answer my question. But today is the first day of the Republican National Convention, as I'm sure you know. And in the beginning remarks, we heard that the U.S. presidential election in November is going to cause some possible market uncertainty, just as Brexit has. What's the European Commission's perspective on what you're expecting under a possible Donald Trump presidency?
Okay. European Commission's line is that we do not comment party politics, not in our EU member states, and least in third countries. So from that point of view, it's a decision for US people now to make. And European Commission and EU is working with democratically elected or appointed authorities of the member states and also of the third countries we are cooperating with.
Well, ladies and gentlemen, this brings our session to a conclusion. I want to thank the Vice President for being with us and sharing his remarks along with his busy schedule and that of his colleagues. Thank you very much for being here. Good to see you, sir.